cannot tell you how many times I see movies financed by one investor who issues a check for the entire movie. It's very easy for the producer to take that check and just go make the movie, but it's also very likely for the investor to lose money, and here is why. Let's take a look at a $5 million movie, and let's assume that our international sales estimates are in fact projected to be 75% of the budget. And let's also assume that US distribution estimates would be 35% of the budget. We obviously have to pay some people, so our collection agent is going to charge us 1% of distribution revenues, and our sales agent is going to charge us 15% of distribution revenues plus 1% in distribution expenses, also charged against distribution revenues. Again, our equity investor is going to finance 100% of the budget, so they will give us $5 million. And in return, they are requiring a 20% premium on the $5 million, which is $1 million, plus they want 50% profit participation and IP ownership. Let's see how that plays out. Our funding schedule is pretty straightforward because we don't have any banks, we don't have any pre-sales, we don't have any production incentives, we just have the investor giving us a check for $5 million to cover the entire budget. And then we are producing the movie for $5 million and we are selling the movie just as projected. We're getting a US distributor to buy the movie for 35% of the budget, which is $1,750,000. So those are the US rights that are now being sold. And then all the international distributors actually buy the movie for 75% of the budget, which gets us $3.75 million. So altogether, we're making with a $5 million movie $5.5 million in gross distribution revenues worldwide. So now we are looking at the people that need to be paid, and the first one in line would be the collection agent. The collection agent charges us 1% of all the distribution revenues that arrive in the collection agent management account, which in this case is $5.5 million. So they're charging us $55,000. The sales agent, who we're assuming is also selling the US rights, to make it simple for this case study, they're charging us 16%, which is 15% of a sales fee and 1% in expenses. And these fees are charged on the international and domestic distribution rights revenues of $5.5 million. Our equity is then being recouped. We're going to have to pay $5 million back, and turns out we actually didn't make enough money to recoup the equity because we have a loss of $435,000. Let's assume we do the very same film, very same script, very same actor, sold the same way with the same sales agent. Everything's the same. The only thing we're changing is how we are structuring our finance plan, how we are balancing the finance sources that we're using. And we're using some of the finance sources that are available to us today. So let's look at this a little closer when we change the finance sources for this very same movie. So again, the movie is $5 million. Our international sales are estimated to come in at 75% of the budget, and we also believe we can make 35% of the budget from US distribution rights revenues. Our collection agency fee is still 1% of the revenues. Our sales agency fee is still 15% of distribution revenues plus 1% expenses. And here's what our finance plan would look like. We would have pre-sales now done for 35% of the budget. The distributors would give us a 20% down payment from these pre-sales. And then we have a senior loan banking the 35% pre-sales. Of course, they are deducting the down payment because we already received that down payment from the distributors. Otherwise, we basically get it twice. And then the gap loan is provided to us looking at the unsold rights, which is our sales estimates minus our pre-sales. Given that our sales estimates are 75% of the budget and our pre-sales are 35% of the budget, we're left with 40% of the budget. And that is why our gap loan is 20% of the budget. And then we are looking at an incentive, and we are going to get a production incentive of 20% of the budget. So now the question is, if we put all these finance elements into a finance plan, how much does the equity investor have to pay now so we're covering our $5 million budget? Let's take a look at our funding schedule. What would it look like if we are applying these funding elements in these finance sources and reduce the equity to cover the balance to then reach our $5 million budget? So first, as mentioned, we are assuming that we can get 35% of the budget from the US and 75% from international distributors. And let's look at some pre-sales that we're making. We're making 35% of the budget in pre-sales, which is 35% of $5 million, and that is $1,750,000. The distributors give us a down payment in connection with this $1,750,000. So the balance would be $1,400,000. This is the balance that we would get paid when the distributors are getting the movie delivered to them. Now let's look at our bank loan. The bank is going to look at the pre-sales and will consider to cash flow 100%. So that is $1,750,000. But obviously, they're going to deduct the down payment that we already received, which is $350,000. And so our cash flow loan amount for these pre-sales is $1,400,000. Now let's look at the gap loan. Again, the gap loan is a loan against unsold rights, and we established before that our international sales estimates are $3,750,000. Of that, we sold $1,750,000, which means we are left with $2 million in unsold rights. The bank needs a 200% coverage, which translates into them giving us half of this amount. They're giving us a gap loan of $1 million. So the cash flow loan for pre-sales is $1,400,000. The gap loan is $1 million. So our gap loan and cash flow loan altogether comprise the senior loan of $2,400,000. And then we have a production incentive applicable because we're shooting in a region where we can get 20% of our budget incentivized. So we are using this incentive in our finance plan because we are approaching an incentive lender to give us an advance on this incentive, and that is a 20% of the budget loan, which translates to $1 million. The incentive lender basically gives us an advance of what they believe the incentive expenses are going to be amount to after we finish the movie and after we shot the movie in the incentive region. So this is an advance that we get from a lender. We can also get it from a bank, by the way. But long story short, because we're getting an advance for the incentive that would be applicable after we finish the movie, and we would normally get it paid after that by the incentive region, we can now use this advance in our finance plan. So altogether, we have now financed $3,750,000, which leaves $1,250,000 to be funded through an equity investor. So now we're financing 25% of the budget through an equity investor. Let's take a look at our recoupment schedule. Our movie is now produced and finished, and we are selling it at the film markets. We're selling the US rights to a US distributor, and we're receiving 35% of the budget, which is $1,750,000. We are also selling our movies to various international distributors, and they are paying us 75% of the budget, and we are receiving $3,750,000. So altogether, we're receiving $5.5 million. Now remember, when we did the pre-sales, the distributors made a down payment, and that down payment was already paid to us. So here, we have to deduct it. Otherwise, we would be getting it twice. So we are left with gross revenues of $5,150,000. Now we are applying all our expenses. First in line is our collection agent. The collection agent received 1% of the amount that actually hits the collection account, which is $5,150,000. Therefore, the collection agency fee is $51,500. Next in line is our sales agent. He receives 15% sales fee and 1% expenses of the gross revenues for the international anti-distribution rights, which is 16% of $5.5 million. Therefore, we're paying him $880,000. Our bank loan is now being recouped at $2.4 million. Our equity is being repaid at $1,250,000. We're paying a 20% premium on this $1,250,000. That is $250,000. So if we are summing up all these expenses, our payment to the collection agent, the sales agent, the bank, and the equity investor, we are paying $4,831,500. And if we are deducting all these expenses from our gross revenues of $5,150,000, we are left with net revenues of $318,500. So now we actually made revenues, where in the case before, we had shown a loss. Now we can pay some profit participations. We're paying the equity 50% of the investment that he's made in relation to the budget. The investment that he made in relation to the budget was 25%, so now we're paying him 12.5% as a profit participation. And that is 12.5% of the net revenue. 12.5% of 318,500 is 39,813. That means the producer receives 278,688. So altogether, our equity investor, in addition to receiving his investment back, made an additional $289,813. As you see, by changing our financial sources and by applying a balanced finance plan for the very same movie, reaching the very same distribution revenues, we now make a profit. If you have any questions at all about this little case study, please feel free to contact me.